ऑप्शंस में प्रीमियम बिल्कुल नहीं है। ऐसी सिचुएशन में क्या कर सकते हैं? विक्स इज एट रॉक बॉटम, premiums are almost dead, and traders are looking for opportunities. Is there any solution? There is a solution, and that solution is called calendar spread. Let's dive into it. Welcome to another video by the Option School. This is your friend Pradeep Singla. If you have ever traded in calendar spreads, please write it yes or no in the comments below. Now, what to do when the VIX is very low and why this is such a challenge? Obviously, when implied volatility is low, the most important ingredient in an option price is missing. In an option price, implied volatility gives you a lot of juice. Since implied volatility is low, so options become cheap, and for option sellers, that means you are taking on the same risk as always, but the rewards are just peanuts. It is like running a marathon, and at the end, you don't even get a medal, just a pat on the back. Lot of effort, almost no gain. That is why low VIX environments feel so frustrating for traders. And this is where most traders feel stuck. They either stop trading or worse, they start taking up big directional bets just to chase returns. And that is a dangerous part. Instead, you need a smarter approach, a strategy that doesn't rely on fat premiums but still generates profits consistently. That is where calendar spread steps in. But then it is an advanced strategy which needs proper understanding. It's not a risk free strategy, but risk is manageable. Let us learn basics and then adjustments. It's a time decay machine basically. It's an option strategy that makes money from the way time decay, or we all know theta works. Here is the setup. You sell a short term option. Maybe it can be 30 days to expiry, 1 week, 2 weeks, 3 weeks, depending upon what kind of calendar spread you are trading. And at the same strike price, you buy a longer term option, let us say 60 days. Let us say if you have sold something which is 30 days to expiry, maybe you will buy something which is 60 days to expiry. So we have different calendars possible. It can be week 1, week 2, weekly calendar, week 1, week 3, another weekly, bi-weekly calendar, week 1 and month end. So it can be a weekly monthly calendar. There can be monthly calendar. I have seen traders doing monthly quarterly calendars where they are selling monthly options and buying quarterly options. I have seen big traders doing monthly yearly options, also selling monthly option against a purchase yearly option. So different kinds of calendar spreads are available. That's it. No complications at all, no combinations, no advanced coding, nothing. Just one short, one long, I will say one of the best strategies, but very simple setup. Now, what I have told is a call calendar spread. Similarly, it can be a put calendar spread also, right? So, if I am doing a call calendar spread, I will sell a call, I will buy a call. Both the strikes will be same. Now, why do we do this? Here, the main thing is theta decay, which is our best friend, because the short term options will lose value much faster than the long term options, and this difference in time decay is our profit engine. So short term options will melt very fast compared to the long term options where the amount of theta will be much lesser. Like it is like running two hourglasses side by side. One has less sand and empties faster, which is a short-term option, while the other has more sand and takes longer. By structuring our trade in this way, we are positioning ourselves to benefit from the faster running hourglass. So the difference in decay is the main source of profit, which is our profit engine in case of calendar spread. One thing is decaying very fast, other thing is decaying very slow. So the thing which is decaying very fast is sold, and the thing which is decaying very slow is purchased, obviously. Now let us build a call calendar spread and see how it looks like. Now take an example from past. It is basically a monthly calendar wherein on 1st September I created this trade. I sold a 24,700 call of month end of 30th September, and as the calendar spreads purchased a 24,700 call of next month, which is 28th October. So where was the market? Market was at around 24,507. So spot was 24,500. I've gone 200 points above the market and sold a call, and same strike price call I have purchased in the next month. So this is a monthly calendar. Few important things to note. There are two break-even points. In most of such strategies, there are two break-even points. Here also we have two break-even points. What are the break-even points? 24,242 and 25,422. These are approximate break-even points, but they work fairly well. So if I say 24,242 versus 25,422, there is a gap of around 1200, almost 1200 points, which gives me a fair range. And we know that okay, the month also started with a very low VIX. So even in a low VIX, I am getting a range of around 1200 points in which my trade will be profitable. Obviously this green area is profitable and this red area is where I start losing money. And how much margin it required? It required around 88,000 rupees as margin. My max profit is 14,953, which is 16.9% of the margin. Obviously, I am not looking for that kind of profit. And the payoff diagram says my max loss is minus 11,000. It will never be there because ultimately the payoff diagram considers that okay, even the October option will become zero, and that is the difference. So that is the basically money you are paying, right? So it will not lose 11,000 rupees. As of now, we should focus on what is the range. Now, whenever the VIX is high, you will get this range as much better than this. So you will get maybe 1600, 1700 points range. So whenever VIX is low, when you are doing a calendar spread, this range slightly shrinks, right? So good risk reward ratio. Obviously, you're not looking for 16% profit, but we are looking for maybe 2%, 3%, 4% kind of a profit in this trade. Now, what are Greeks? Important to see what is the value of Greeks in this trade. So in this trade, if I see, it is almost delta neutral. 3.75 is my net delta. Theta is there, 105 rupees. It starts giving you faster money as we approach towards expiry. Gamma is negligible as of now. And main important point is this, 840 plus Vega. Now positive Vega basically means that okay, as of now VIX is low, and whenever the VIX will rise, this positive Vega will be my additional profit. Let us see more about this Vega in our coming slides. Now let us understand the profit and loss also, which I have already explained. The sweet spot, the maximum profit is achieved if the stock price is at the strike on the expiration of the short option. So we have only one strike price. In this case, the example I have shown, it was only 24,700. That is the only strike price for buying as well as for selling. Only the expiries are different. So if market expires exactly at 24,700, that will be the best case scenario. If I see here also, this is the point which is best case scenario where the peak of the profit is there. So if market expires exactly at 24,700, the 24,700 September call will become zero, but 24,700 October call will retain its maximum value, and hence it will be a maximum profit spot. That is the sweetest spot in calendar spread. But again, I will say we do not trade to make maximum profits. We always trade to make rational profits. So the trade loses money if the stock moves too far in either direction. So as we have seen in the payoff diagram, if the stock moves in either direction, upside or downside, on both the sides there is a break-even point. And if the stock or the market or index or Nifty, whatever we are doing, if it moves beyond those break-even points, then definitely we need to do some adjustments in the trade. Now let us see another beautiful thing in calendar spreads, and what is that? Why it is so great for low VIX. Most option strategies need high premiums to be profitable, especially for sellers. But calendar spreads do not depend on that. The profit is from the difference in the decay, and that is why it's a perfectly low Vix environment. Also, there is an additional benefit also. Calendar spreads have positive vega, as I have shown you. It was plus 840. Now this is something traders must understand, that Vix is, which is a mean reverting phenomena. It will become low, then it will again become high, it will become low, again it will become high. So when Vix is rock bottom, we should trade strategies which are positive vega, because from rock bottom नीचे से वापस ऊपर जाएगा, and whenever it will go up, this trade will give you more profit, additional profit than your theta decay. But in case at low Vix you do a short strangle, if Vix goes up, short strangle is a negative vega strategy. If Vix goes up, both the prices of call and put will go up, and that trade will start giving you loss. But this is the only trade in which theta is positive, vega is also positive. So if Vix goes up, that is an additional benefit in calendar spread. It's not at all reliant on high premiums, it's just time decay. But since we are positive on vega, if the low volatility starts, obviously volatility will not become 0. If it is 10 now, from here, yes, it can go to 9, 8.5, but then ultimately you do expect that, okay, volatility either will remain here, which is almost lowest, or maybe it will go up. So if it goes up, it's extra benefit. If it doesn't go up, it stays here only, then the theta decay play is always there in this strategy. So is it risk free? I really found it bad that, okay, so many people claim that it's a risk free strategy. It is not a risk free strategy. We need to understand before deploying this strategy what are the possible risks in calendar spread. The biggest enemy is the large price move. As we have seen in the payoff diagram, if market moves wildly in either direction and goes beyond the break even point, if it goes up and break the upper break even point, again there is a red area where we will have losses. And if market falls very sharply and goes to below the lower break even point, then also there will be a loss. So definitely we need to manage this trade whenever we face a situation where the stock or the market is moving beyond the tent. The real tent is there in the payoff diagram. As long as we are within the tent, we are safe. But as long as things are going outside the tent, obviously the external environment will hit, right? It's like as if you are in a rainy season. As long as you are inside the tent, there will be no rain. But as soon as you start moving outside the tent, definitely there is a chance that you will get drained in the rain. So we must understand what are the risks possible. A big wild move is definitely a risk in calendar spread, and how to manage those risks. So what to watch out for is large price moves. Large price moves, which is our biggest enemy. The stock must stay in the expected range. And then another risk is vega risk in case volatility goes further down. Once we have created the trade and Vix goes further down, then definitely Vix will also start losing money for us, right? But generally that is why traders try to trade calendar spreads when Vix is rock bottom. In fact, when Vix is rock bottom, this is an opportunity to create calendar spreads. So if you create calendar spread when Vix is 15 and Vix from 15 goes to 12, then a good calendar spread can also give you a loss. But if you are creating calendar spreads when Vix is 10, then chances are from 10 it can go to 9.5, or if it goes to 10.5, 11, it will give us a profit. So chances of Vix going further down are low. That is why we are taking our bets. Now what happens if the market doesn't behave in our favor? Your profit tent is breached. What to do? Now there can be two scenarios basically. One is market moving wildly up and we need to manage an upside breach. Second possibility is we need to manage a downside breach in case market suddenly falls. So there are smart adjustments, there are smart ways to handle both upside and downside breaches, so we need not panic. But instead of rushing through it here, let us keep that for our next upcoming video, which most probably will be coming in a day or two. I will walk you through some practical adjustment techniques step by step. So here is the takeaway. When volatility is low, Premiums are dry. Don't sit out of markets feeling helpless. Instead, think smarter. Calendar spread give you a way to profit in conditions where most traders might be struggling. They are not magic, they are not a jackpot, but there's a steady, reliable tool in your trading toolkit. If you enjoyed this video, hit the like button. Drop a comment telling me if you have ever traded calendar spreads before and what was your experience. And of course, subscribe to the channel. We'll continue to simplify optional trading strategies and we'll be coming back with great content. Thank you.